On Point with Craig's Investment Partners.
Right. Hi there, everybody. We'll get the formalities out of the way first. The information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor, and you can find out more about our services in that regard by going to our website, which is craigsip.com. I wonder if you guys all get sick of hearing that as much as I get sick of saying it. I suspect so. Anyway, what I wanted to talk about today is I just wanted to have a bit of a discussion about how to implement a portfolio, and a bit of jargon's creeping in there. What I mean by that is, if you're lucky enough to actually have some money to invest, how do you do that? Do you jump in boots and all and invest it today, all in one go, or do you try and bide your time and look for a better opportunity? That's tough to do as well. Or is there another strategy you should use? Because I know there are a lot of people out there who are lucky enough to have a bit of surplus cash of varying amounts. Maybe you've sold a property, maybe you've had an inheritance, maybe something else has happened that has meant that you have got some money that you would like to work harder for you. Maybe you've just been sitting on a pile of cash and have been on the sidelines for a period of time, and you're thinking, surely I can do something more productive with this. But for whatever reason, you've ended up with a bit of surplus cash, and you're thinking about how to put that to work, and it's really difficult to do that. It takes a huge leap of faith, and a lot of people don't know where to start, which is why a lot of people end up taking the easy option, which is to do nothing, just leave it be, leave it sitting there in the bank. And I guess the good news there is that instead of getting 1 or 2%, at least you're getting 5. That's good. So you're getting a modest return, but an adequate return, and you're taking on very little risk, so you're not losing anything. That's a sensible strategy in the short term, but it's obviously not a long term investment strategy. Cash and deposits don't give you any growth, and they don't give you, well, they give you very little in the way of inflation protection. We talked about that a couple of weeks back in one of these podcasts that addressed the differences between nominal returns and real returns. So go back and have a listen to that one. That was quite an interesting one that I got lots of good feedback on. So that's one of the issues with leaving the cash sitting there on the sidelines. There's also the matter of interest rates, which have gone up really quickly over the last couple of years. So we've gone from sub 1% from term deposits to north of 5 in a short space of time, and that's great for savers, or with people with cash sitting in savings accounts of various types out there or on deposit. But they could fall just as quickly. If inflation did slow more quickly than people were expecting, if the country fell into a recession of some magnitude, you would see our central bank and others around the world, if this happened overseas, you would see those central banks reverse course and cut interest rates. And what that means is, if you've got money on deposit for 6 months, 12 months, even 24 months, when it comes up for maturity, you could be looking at quite a different backdrop in terms of where interest rates are. So you've got to think a bit more longer term. So I think the end goal, if you've got some money on the sidelines, is that you want to get that hard-earned capital working for you. So you want to get it invested at some point, but how do you do that? It's a very common dilemma, because it's quite scary thinking about venturing into the financial markets or any asset class, property, farming, anything that involves risk. It's quite scary to sort of take that leap of faith with your savings. And quite often when things are going well, you wonder if you've missed the boat. And some people might feel a little bit like that lately, because we have seen the New Zealand share market. It's been rising since the middle of last year, and it's put on a pretty decent performance in the last several months. And we've seen that overseas as well. Overseas markets, since about October last year, they've been rising. So we're now into May, and markets have strung together several months of quite good returns. So you start thinking, geez, it would have been great to go back in time and put this money to work middle of last year, but I didn't do that. So, is it too late? So people feel like that when things are going well. Um, And when things are going badly, when markets are sort of looking a bit challenged, you also feel a bit nervous, because when things are rough and really up and down, and they've been like that as well recently, then it feels safer to just wait for things to get better. So, what do? One option is to close your eyes, grit your teeth, and just jump right in all at once today. And that probably sounds pretty outlandish, but ironically, all of the evidence, and there's lots of it, lots of different organizations and economists and market watchers and so forth have done lots of studies over the years. And while it sounds outlandish, that's actually a wise move according to the evidence. And the reason why is because most of the time share markets rise, right? So every 4 out of 5 years are good. You do get the odd bad year, but most of the time markets are headed upwards. And over the past 50 years, I looked at the returns for shares in New Zealand, Australia, and in the US. And over that period, the returns from all of those markets per annum have averaged about 9 to 10%. Slightly different for each of them, and you can look at that analysis if you talk to your advisor and get the report, because I put these down on paper. So 9 or 10%, that's kind of the typical return, including dividends reinvested over that period. And that you get positive returns probably 75 to 80% of the time. So when over that 50-year period, I split that into all of the different 12-month blocks. It's monthly data, and looked at all the different 12-month blocks. And uh, if you look at the entire set of all of those potential times when you could have started investing, then over a 12-month period, you would have been up 74% of the time in Australia, 79% in New Zealand, and 78% of the time in the US. So the other way to think about that is 80% of the time, or almost 80% of the time, markets are going up rather than down. And because of that, you're actually better off just getting on with it immediately rather than sort of waiting around for a better opportunity. However, no one wants to sort of hit that other 20%, do we? No one wants to be unlucky enough to invest that money right at the top of the market, or just as things are starting to head south. And that's obvious, to say the least. The price you pay for an asset or an investment has a big influence on your future returns. So no one wants to buy their house, in November 2021, right at the top of the market, or back in the first half of 2007, like I did when I bought my first home. Wasn't fantastic timing. And people also don't want to put their money into, share markets or bond markets, or another sort of investment strategy, a fund of some sort, right at the top before things head south. So because of that, our natural inclination is to sit back and wait for the downturn, and then take advantage of buying at cheaper prices, which again, stating the obvious, aren't I? Buy low, sell high. That's a good idea in theory, but for that to work, you've got to have a pretty accurate crystal ball, because it's extremely difficult to predict where the market is going next. And they've got a habit of proving us wrong. Even those of us that live and breathe financial markets and have done for years and decades, it's still incredibly difficult to pick where they're going next, particularly over the short term. Over the long term, you've got a better chance, but over the short term, and when I say short term, I mean over the next 6 months, 1 year, 2 years even, very difficult, and you will be proven wrong. And sometimes, the long heralded slumps that we're patiently waiting for, the recessions, the downturns, sometimes they don't arrive. Or sometimes they don't arrive as quickly as we would like, or sometimes they're not as deep, or sometimes the snapback, the bounce back comes a lot quicker than we expect it to, and we sort of miss the boat. So I guess what I'm trying to say is, it's easy to look back in hindsight and go, well, the best times to invest were in the depths of recession and during those periods of negativity, like, through the 08, 09 period in the GFC, or in, February, March, April 2020, when we're all worried about COVID, or, parts of last year. At the moment, look like they were quite a good time to put money to work. But during those periods, most people aren't brave enough to follow through. It's easy to say that in hindsight, when you know that the recovery came after that. But when we're in the thick of those periods, we're often quite reluctant to actually follow through. And what we tend to do is we wait for evidence that things are getting better before we make our move. And by the time we're seeing that evidence, prices have already moved. We've missed a good chunk of the rebound, and we're sort of right back at square one. So it's pretty tough, and I guess it's like a lot of things in life, but particularly in financial markets, being at one extreme or the other is quite risky. It's not where you want to be. So, of course, you don't want to dive in boots and all. That just feels imprudent. It feels risky. But at the same time, waiting on the sidelines or waiting in the wings for the conditions to be perfect, that can be equally unwise. So that's why a lot of investment advisors will tell you to put your money to work little by little, bit by bit. They'll say stagger your way in. If you've got $100,000 or $1 million or whatever it is, cut that up into 4 pieces or 10 pieces or whatever it is, and invest some of it every month for the next 12 months, or every quarter for the next 4 quarters, or maybe over a shorter time frame, a longer time frame. It all depends how comfortable you are and how nervous you are and sort of what market conditions are like. But it's a strategy that most investment advisors will use when they're trying to put people's capital to work. They often call that installment investing or dollar cost averaging, because you're sort of reducing your price over time, and the result you get is more of a middle of the road outcome, because you'll end up overpaying at some point. You'll pay more than you would like, but you'll also pick up some bargains. And what you do is you take that risk of just putting it all into the market on one specific day and just hoping that day turns out to be a good time to buy. So spreading that investment over a longer period is a very wise thing to do, and it reduces risk, and it passes the sleep test. You'll sleep easier at night knowing that you are hedging your bets in that sort of a manner. And that's something you can't do in other asset classes. If you're looking to invest in a residential property, an investment property, or a farm, or if you're going to buy a business, a private business, that is. If you're going to buy a commercial building, you don't have that luxury. You want to buy that rental property, you've just got to buy it all on that one day, and that might be the right price. You might have caught the bottom, or the market could keep falling. And in hindsight, you'll regret that you did that. But you don't have the choice, because you can't buy one bedroom now and another bedroom sort of next month, and then the garage in 6 months' time. But with a share market, you can do exactly that, because the market is very liquid, and you can buy in smaller parcels. You can just pick up a few stocks or parts of the portfolio. You've got your shopping list of what you want your portfolio to look like at the end. But you don't have to buy it all on day one. You can do it in chunks. You can stagger that investment, which allows you to spread your risk, and that is a really good strategy that can swing the odds sort of back in our favor. So that's pretty much all I wanted to say. If you're sitting there with, and you're in the privileged position of having some money to put to work, and you don't know what to do, you don't have to make this massive call and either do nothing at all or do everything all at once. You can take your time. You can do it bit by bit. You can use a strategy like this to reduce your risk, and hedge your bets, and invest it over a period of 3 months, 6 months, 18 months. If you have a bit of uncertainty about what the future looks like. So it's a really good strategy. Hopefully that's a bit of food for thought, and any investment advisor that's any good will know exactly what I'm talking about, and I'm sure they'll be more than happy to discuss that sort of approach if something I've said resonates with you. So talk to your investment advisor. If you don't have an advisor, give us a call. We would love to help people who are pondering these sorts of issues and thinking about how they can use these sorts of strategies to get their money working harder for them, but in a way that will protect them from any adverse market movements. All right. Thanks, team. Talk soon.
For more insights, visit craigsip.com.